So before we go into forecasting fixed assets have some major component with respect to accounting, which are cost. So you have some cost at which you record the fixed asset. Whenever you buy a fixed asset, you record it at cost on your balance sheet. Then throughout time, you depreciate these assets. So every year you charge some depreciation expense. This depreciation expense is charged every year and it keeps on getting accumulated. And when you keep on adding it for every year, then it becomes accumulated depreciation. Then you may buy some assets or dispose of some assets. So when you buy those assets, these are additions, and again you will be recording them at cost at which you bought them, or disposals. And when you dispose of some asset, you remove it from the balance sheet, you remove its cost, you remove its accumulated depreciation, and you record a gain or loss in your P&L. So that means so that means cost plus additions minus disposals minus accumulated depreciation should give you net book value. And this net book value is reported on the balance sheet. So on balance sheet, the asset number that you see on balance sheet is net book value. So it starts with cost, then you subtract accumulated depreciation to make adjustment for addition disposals, and then you arrive at net book value. Any problem, any confusion so far? So this means in order for you to forecast assets on balance sheet, you need to forecast net book value. And in order to forecast net book value, you need to forecast cost, addition, disposal, and accumulated depreciation. For you to forecast accumulated depreciation, you need to forecast depreciation expense and have some assumptions about future additions or disposals, which means capex. So additions are simply your capital expenditures. So fixed asset schedule or fixed asset sheet would simply contain all these details. It will start with cost, then accumulated depreciation, then additions, disposal, and will help you arrive at the net book value. And the methodology will remain be the same as we did in past. So we will put in past data for past 2 years or whatever, and then based on that and based on trends found from there, we will forecast future. And based on the notes or based on the information provided in notes, we will forecast future. Any problem so far? Okay, so let's. Okay, so this is the sheet that I have made in this model for forecasting fixed assets. Okay, so this is the sheet that we have made for non-current assets or fixed assets or whatever you call it. So if you look into the sheet, it starts with cost, then it has additions and disposals, then depreciation, then accumulated depreciation, and then net book value. So these are the same series of items which we just discussed. So there will be multiple assets within property, plant and equipment. There are buildings, machinery and equipment, land, construction in progress. And where do you get this from? You get this from the notes. So in annual reports, you have notes, and from there you find out the breakups or find out the values of different items. So if you look into it, I have put in the past data, which is data for 2015 and 16, for example. And I have also listed down the life, and you can have an estimate of life from here. You can have estimates of depreciation methods. You can have, so in this case, a straight line depreciation method is being used for all of these, and these are the lives of these different assets. So I have put in the cost of 15 and 16. This you can easily find out through notes. Then I have put in the additions of 16 and of 2016. And moving on, I have depreciation, accumulated depreciation, and net book value. You can also put in, so it now depends on you how much detail you want to go into. So ideally, what you should do when you are making your model, what you need to do is you put in these depreciation expenses as well, and put in these accumulated depreciation as well, and then calculate net book value based on that. So once you have made this sheet, then you need to forecast, or then you need to move ahead. So in this particular file or version, we have forecasted the future depreciation. Now, there can be multiple methods of forecasting future assets, or forecasting future additions, or forecasting future depreciation. So starting with cost, if you look into the cost, what is cost? Cost is simply previous year's cost plus additions minus disposal. So that means I can simply put in a formula that cost is equal to previous year's cost plus addition minus disposal. And the same formula will be replicated in all these cells. So for cost, simply the formula is previous year cost plus addition minus disposal. And all these additions disposal will be taken at cost. Now moving on to additions and disposals. So these are the additions and disposals for 2016. How did I calculate it? So from balance sheet, I know that in 2016 PPE was 19385, and in 2015 it was 19655. So I have the figures of 2016 and 15 from balance sheet, and the difference of these two I have taken as the additions or disposal. What you can do is, when you go into and this will give me the directly the net book value addition or subtraction of addition or disposal. What you can do is, you can go to notes and you can find out the exact workings of these additions and disposals as well. So if you want to go into that detail, you can find out the exact workings of additions and disposals, and then you can make up a fixed asset schedule in which you can give further details, or you can provide further details as to depreciation of disposal, as to accumulated depreciation of disposal, gain of disposal, and cost. Otherwise, if you want to simplify it, so I have kept it very simple for explanation purposes. I have taken it as from the balance sheet directly. So if I look into it, these are the amounts of additions or disposals. Now moving on,